We have great visions of retirement. You know, maybe it might be on this island, maybe chilling in the boat. But it's always a mystery of how people actually get there, to have that success, to find that retirement dream. It's a challenge. There's a lot of different things that you need to know. That's what we're going to get in today, so stick around. We got a great show lined up for you. My name's Joe Anderson. I'm a certified financial planner, president of this company right here, Pure Financial Advisors. And this show just wouldn't be the show without the big man. That's Big Al Clopine. He's sitting right over there. We're going to break a few things down for you, because when you look at retirement, you got IRAs, 401ks, Roth IRAs, 403bs, TSPs, KEOs, defined benefit plans, Social Security, and the list goes on and on and on. What do you do? How do you save? Is there a match? Not a match? Do I go after tax, pre-tax? What the heck is all this jargon? Can I just get to my retirement, please? We're going to break it down. That's today's Financial Focus. This is a problem. This might help us get to our financial dreams, is that there's $24 billion lost in matches. So if you have a 401k plan, your company might match a certain percentage of what you're putting into the plan. 25% of individuals are not even taking advantage of the match. They're leaving $24 billion on the table. Folks, it's free money. It's 100% rate of return. So what we want to do today is to make sure that you're not one of these few that are missing out on a huge opportunity. To help us out with that, let's bring in Big Al. IRAs, 401ks, 403bs, TSPs.
There's simple as mud, huh?
Right, and then
There's
you got
mud.
certain contribution limits for some plans. Can you do both plans? Do I take the pre-tax, after-tax, tax-free, taxable?
It's any wonder, Joe, that there's a mystery when it comes
to
retirement planning. And so today, we kind of want to break it down for you. So we'll kind of start with basics, and then we'll get into a little bit more advanced. And so this show there's a little bit for everybody. So at the very start, we're going to talk about IRAs versus 401ks, pros and cons of each. And did you know, if you have a 401k, you can also do an IRA as well. They're not mutually exclusive. How about a Roth IRA versus a regular IRA? When do you want to consider both of those? We'll get into that. Investing basics, we'll get a little bit more advanced. And then finally, we'll get into rental real estate. This is another thing. A lot of you guys ask us about, should I invest in real estate? And I've been an investor for about 30 years in real estate, and I'm going to give you some of my thoughts on that, probably that last segment. So, Joe, I think this will be a great show for just introducing a lot of concepts and making sure people have a good grounding, kind of the ABCs of saving for retirement.
Big Al on real estate?
That's it.
Did you write this show?
I did.
He's been begging us to put real estate in this since the beginning.
Yes.
So let's just kind of break it down, right? So we got different types of savings accounts that you can get into, right? There's IRAs, 401ks, and non-retirement accounts. And each of these have different taxations, and then some people sometimes forget or don't understand, hey, can I invest the same thing in my 401k or an IRA? You know, so yes, when it comes to an IRA or 401k, you could have ordinary income tax, so you get the pre-tax deduction going in, and then it's going to be taxable going out. You can invest in stocks, bonds, real estate, just about anything besides collectibles. So you can't put your art collection in there or life insurance. Then there's also a tax-free component to those plans as well. So maybe you don't take the deduction going in having all of your growth grow tax-free. And you can invest, again, in the same stocks, bonds, real estate, commodities, whatever that you want. So it's not necessarily an investment in itself. It's just a shell that you can put investments in. So depending on what your investment strategy is, that's going to determine how you fund each of these different accounts. So you want a little bit in all of these when it comes to your overall strategy, because sometimes people just focus on one thing. Maybe it's your 401k plan that you're getting a tax deduction for. It's growing tax deferred, but then you hit retirement and every last nickel that you're pulling out is going to be taxed at ordinary income brackets. So Al, it's looking at different options here when it comes to your strategy to make sure that, yes, you should be saving. That's the number one thing. But then let's get a little bit more in the weeds here. What type of taxation should you look at and what type of investments?
And Joe, when you have a 401k or a 403b, as you mentioned early on, there's often a match. The employer gives you a match. And
Right.
what that means is you put in $1, your employer puts in $1. That's why it's a 100% return in the first day. So you want to take advantage of the match. Realize that with the 401ks and 403bs, you generally have a regular option, which allows you to get a tax deduction, or a Roth option, which allows you don't get a tax deduction, but it grows tax deferred, or tax free, I should say, down the road. Realize when you have 401ks, 403bs, generally you're limited to stocks and bonds and things that own those two, like mutual funds, index funds, ETFs, and the like. Generally, you're not allowed to own real estate inside your 401k. Although, as we mentioned, you can own it in your IRA with a self-directed IRA. But then, Joe, we also get into what happens if I want to invest more than just a retirement plan.
Right. I mean, there's a sequence of savings. I think you go to your 401k plan first to get that match. Then from there, you might want to look at an after-tax component, such as a Roth IRA. And then once you max out those plans, now get into non-retirement. This is maybe just a brokerage account. You have special tax treatment. This is where you could buy stocks and bonds. But then here, what we see in Southern California is a lot of people have a real estate portfolio. That's outside of your retirement accounts, of course. And then so if you sell those properties, that's going to be taxed at a lot favorable rate, such as capital gains. So you want to start building these pools of assets, right? But the first number one thing you got to do is save.
Yeah.
You got to save money. So if you don't save, it's all irrelevant.
Yeah, that's true. And Joe, I want to go over just some of the basics on savings. So when you look at an IRA, it's $5,500. That's the amount that you can save each year into an IRA. If you're over 50, there's a $1,000 catch-up. Now, you do need earned income. You need to be working, but there are limitations on income. In terms of a deductible traditional IRA, when you make too much money, you can't deduct it. You can still make it. Roth IRAs, you cannot make over certain income levels. And as far as age limitations, with a traditional IRA, you're not allowed to contribute at past age 70, but a Roth IRA, you can. So there's a lot of these different rules. And then you look at the 401k and a 403b, now you can put in $18,000, and it's not really fair if you have an employer that doesn't have a 401k. You can only do that IRA.
It's ridiculous. It's
Right.
so stupid. It's like,
Right.
all right, well, Al, you work for a great employer, and I work for a great employer, but I don't have a 401k plan. Al does. He can put $18,000 or 24 in. I can only put in $5,500. The statistics show that people that have a 401k plan have a lot more savings because it's out of sight, out of mind. So when you look, all right, are you fully funding your 401k plan? Start there, right? Get that match. Get it out of your paycheck before you can spend it. Because you have to start paying yourself first. I don't care if you're 20 years old, 30 years old, 40 years old, or 50 years old, or 60. You have to take a look, are you saving enough money? I don't care what the market does. I don't care about taxes. If you're not saving any money, it's irrelevant. Start there. Start fully funding the plans that you have available to you. And you're going to thank me 20 years from now. I guarantee you that. All right, we got a lot more to discuss. We're kind of getting in the ABCs here of retirement and breaking through this whole mystery of how do you become successful. It's not as hard as you might think. Stick around. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here alongside Alan Clopine. We're talking about getting the mystery out of your overall retirement plan. Before we get into the meat and potatoes of the show, let's go to the true false.
If I work 2 jobs, each with its own 401k savings plan, I can contribute twice the maximum limit. Oh, that's a great question. True, false, that answer is false. So we just talked about the maximum limit is $18,000 per person. Now, if you're over 50, you get a $6,000 catch-up, so you can do $24,000. But if you have 2 employers with 2 401ks, you can give no more than that $18,000 between the 2 employers, or $24,000. So you cannot double up on that. Joe, interestingly enough, though, you are allowed to do a maximum 401k and maximize an IRA or Roth IRA contribution.
Yeah, let's say if your side gig, though, maybe you have a side hustle. You're self-employed, and you're putting in $24,000 into the 401k plan. You could do a SEP plan. The maximum defined contribution limit, what is that, Al? About $54,000.
$54,000.
So you can get up to $54,000 pre-tax, but you have to follow the guidelines of the IRS. So you cannot double up on a Section 401k plan. Those are just sections in the code. But maybe I have a 401k plan with one employer, but I'm really doing very well in my side hustle, and I make a ton of money there, I can fund, let's say, a SEP plan, a self-employment pension plan, or something of that nature, and get up to that $54,000.
Yeah,
so it depends.
And it's interesting, Joe, because there are, as we said before, there's a lot of different rules. And speaking of rules and questions, we've got a question for you today, my friend. We call this Countdown to Retirement.
Hi, Joe. My question really is, I have a spouse that passed away in June of this year, and I need to take distribution on IRA accounts and annuities that are in IRA accounts, as well as a 401k. What is the best way to do that?
That's a really good question. All right, so his spouse passed away. First of all, I'm sorry for your loss. Second of all, now you have all the complex world of retirement plans and required distributions. So it really depends on a couple of different things. There's two things that you can do as a spouse. You can keep it in the spouse's name, or you could roll all the money into your name, all right, into your account. And there's pros and cons to each. If you roll it all into yours, then you just have one pool of money. You take one required minimum distribution based on your life expectancy. Or you can keep it in the spouse's name, right? And then depends on when she was, how old she was, right? If she was already taking distributions, then you could potentially follow her distribution track. Or you set it up as an inherited IRA, but you have to take the required distribution based on your life. So in your situation, I think to make it very simple, because spouses can commingle, I would commingle those accounts, just put it all into one IRA so you don't have to worry about taking all these required distributions from several different accounts. I think that would make your life a lot easier.
I agree with that, Joe. I think simplicity is a good thing, especially as we get older, and the required minimum distributions are anything that's but simple.
Right, he might have had to take 5 or 6 different distributions. He had to take his, and then it sounds like, well, there's some annuities in an IRA. Maybe she had a 401k plan. So then those are 2 separate distributions on her side, then on his. So, I mean, just to try to keep track of what those numbers are and what that distribution is in each of those different plans. As you get older, because if you screw it up, it's a 50% tax penalty. A 50% tax penalty on what that distribution should have been. So if you missed a $10,000 distribution, right, that's $5,000 tax penalty, as well as the $10,000 that needs to come out with additional $5,000 and the tax on top of that. So you don't want to screw up any type of RMDs, and the older we get, sometimes the math, I don't think you want to deal with it.
Yeah, I don't think so either, Joe. So we're going to change topics a little bit right now. We're going to talk about Roth IRA versus regular IRA, or Roth 401k versus regular 401k. It doesn't really matter which one you look at. So we're going to look at this very simple example. This is somebody that saves $10,000 a year for 30 years at a 7% rate of return. Under a traditional retirement account, they would end up with $945,000. Let's assume they're in the 25% tax bracket. So their taxes would be $236,000, and they would have $709,000 available for their own retirement. Now contrast that with a Roth IRA 401k, putting less in because there's no tax deduction. So you put $7,500 in for 30 years, you still end up with that same $709,000. So interestingly enough, if you're in the same tax brackets, you end up in exactly the same place. And Joe, I think a lot of people get confused with that because they think, I'm putting less into a Roth, so I'm never going to catch up with the other account. But when you look at this net of tax, it's a whole different story.
Right, and I can tell you put that spreadsheet together, because there's flaws in kind of, he's numbers, right? I look at real life. And so if I don't get the tax deduction, I'm putting less in. Yes, I understand that. But then in that example, it's like, all right, well, my IRA grew to almost $1 million. If you pull $1 million out of a retirement account, I'll tell you what, you're not going to be in the 25% tax bracket. You're going to lose half of it if you pull it all out, because you're in the 39.6 federal, 10% state here in California. We call it 50%. You want to look at the tax diversification. It's not all or nothing. It's not like I'm going all Roth, I'm going all traditional, and let's just look at the numbers in a bubble. I think that's where people fail to understand the magic of this type of planning, is to say, all right, well, here, I'm going to have a little bit of pre-tax, a little bit of after-tax, and a little bit in a brokerage account so I can control my tax liability once I'm in retirement. So when you just look at one thing in a certain area, I think you might make the wrong decision. But you're right, Al. It's like, all right, well, if I just look at the straight numbers here, because I don't get the tax deduction, it grows tax-free, but I can put less in, because what he's saying is that I'm putting $10,000 in, but it's only costing me $7,500 because I get a $2,500 tax deduction. That's great. So the other side, well, you can't put the $10,000 in because you got to keep it apples to apples. I don't know. That's Big Al for you. So, are you confused
well,
yet?
and there's a couple other considerations here too, and I think, Joe, you said one of them right off the bat, which is when you have money in a Roth IRA, and it's not all or nothing, of course, but then you have flexibility in retirement.
Right. You don't have a required minimum distribution.
You bet.
Pass
You
the
bet.
kids tax-free. Pass. I mean, there's a lot more advantages, I think, than disadvantages.
There really are, and of course, if you're in a lesser tax bracket, like when you're younger, a Roth certainly is a no-brainer. Or when you retire and you don't have a lot of income before your required minimum distributions kick in, then that's the time to do it as well.
No, I agree with you.
So then it's a matter, Joe, of how do we invest in our IRAs, in our Roth IRAs? And I guess right off the bat, it's very simple. The main two investments are stocks and bonds, and a lot of folks need a little refresher here. A stock is just investing money in a company, right? And what you get is an ownership, and if the company's profitable, you get a dividend. And hopefully that company keeps growing and your stock price keeps growing. That's what a stock is. A bond is making a loan. So you're loaning money to the company, and in exchange for that loan, Joe, you get an interest payment, and hopefully you get your principal back at some point.
It is two totally different types of investment vehicle where I still think people get confused. We look at our investments on a rate of return basis. So I look in the review mirror, okay, well, this particular investment averaged 10% over the last 10 years. This one did 3%. So the 10%, of course, must be better. Now, you have to take a look at what type of instrument that you're investing in. A stock is going to be more risky than a bond in most cases. A bond is just a loan. You're loaning your money to an organization in return for an interest payment. At the end of the loan, you get your money back. If I own a stock, I'm an owner of that particular company. If I own McDonald's, I'm not in there flipping burgers, but I'm getting the profitability of that overall organization. So McDonald's could go under because no one wants fast food anymore, right? So then you're going to lose money. But if I loan my money to McDonald's, as long as they're still flipping a burger, even though it's less burgers, I'm still going to get my interest payments as long as they're still in business. It's a totally different investment. I still think people get confused. So stocks and bonds, you can invest in both of those. And why do we invest in the first place? Is inflation.
Yeah,
right?
That's right, Joe. Because a lot of people in retirement, they think, well, I don't want any stocks because they're too risky. But you got to have some stocks to keep up with inflation, and this is not that long a period of time. This is what $20 would buy you back in 1998, almost a full shopping cart. 2005, a little less, and 2013, when this was created, it's not that much at all. And it's amazing how inflation takes a lot more money to buy the same things.
Right. I like those grocery carts. I thought that said silently rubbing you.
It
Since
might have.
1913.
I didn't read it closely.
I was like, well, maybe it was robbing. I don't know. Since 1913, but then the slide,
I don't know.
Okay.
I didn't create it. Anyway, so just go with it, right?
So, all right, then you take a look at what type of allocation. I think people get confused. All right, well, we talked about stocks and bonds. We got to combat inflation. Well, it depends on your time horizon. If you need that capital 0 to 3 years, you don't want any money in stocks because it could all crumble at any moment. 5 years, okay, now you got a little bit more time. Maybe it's 20%. If I look at 7, 10 years, now we're looking at maybe 40%, 50%, get up to 70%. If you have 20 plus years, maybe you want that allocation 100%. So it depends. I mean, the younger you are, you have more time to get the peaks and valleys with it and let those investments actually work for you.
Yeah, and of course, Joe, that's just one factor of how you pick stocks and bonds, but that's at least
Sure.
a kind of a marker right there. I mean,
Right. I mean, that's not our, I guess, recommendation
right,
in a
but
sense. It's just
it's
to
kind
give
of
an
a
idea.
maximum, kind of a reality check, because
Right.
a lot of times people come to us and say, I've got some money that for about a year.
Sure.
Where should I put it? And the answer is in a bank account. I mean,
Cash.
you don't want to take any risk on that one.
Or those, you might have a 20, 30-year retirement ahead of you, and most of your money's sitting in cash. That's not the right answer, too. You have to look at your entire time frame. I think, especially with retirement, people think, all right, my retirement date is the finish line. No, that is not the finish line. That is the starting line for most of us, because now we have to live off our capital for the next 10, 20, 30 years, sometimes 40 years. You will need some risk in the portfolio. In most cases, prices to combat inflation and taxes.
Yeah, Joe, let's summarize the basics here. So consider your maximum stock allocation. We just went through that. It doesn't mean that's the amount that you do, but don't go over that. Use low-cost index-type funds is what we recommend. Globally diversify. Have a little bit of everything because you never know what's going to do better than anything else. And monitor that portfolio. Don't just let it be. Rebalance as you need to. Tax manage as you need to.
Hey, when we get back, we got a little bit of a new segment. We're going to ask Big Al all about real estate. So if you're thinking about buying rental properties, Big Al's been doing it for about 30 years, so you don't want to miss that. Show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Alan Clopine hanging out here. Hopefully you enjoyed the show this far. Hey, we're wrapping things up. We got Al's thoughts on real estate coming up. You don't want to miss that, but let's go to the true-false question.
An employer match made on my Roth 401k contributions is deposited into my Roth 401k account. That's a great question. The answer is false. When you put money, your own money, your pay, I guess, into the Roth side of things and your employer doesn't match, your employer gets a tax deduction. So therefore that match, yes, it comes to you, but it's in the regular 401k side. So it will grow tax deferred, but you will pay tax on those dollars when you pull them out. Yeah,
that's a good point. So if you max out your plan, you put in the $24,000 and then the employer matches you, let's say $5,000. And then you only went Roth the whole time, and that $24,000 grows to whatever. That pool of match money is totally in a separate account, and it's going to come out taxable to you when you do take those distributions. So, hey, let's get Big Al's thoughts on real estate. I wish we had like a cool stinger. Maybe we can come up with something fun.
Yeah, maybe next time, Joe. And I guess this is as a result of about 30 years of investing. I've invested in condos, single-family homes, apartments, vacation rentals. And I would tell you this, you can make a lot of money in real estate. I've done that.
Look at the big wallet on Big Al.
But you can lose a lot of money in real estate, and I have done that too. And so my third point is it's a lot harder than you think. In fact, if you watch those infomercials at night, you would think it's very simple. It's not. I can tell you, after doing this for 30 years, it's not simple at all. You can do well, and you can do very poorly. Here's maybe some keys, though, is make sure you understand the property's cash flow. Understand what you can rent it for, understand what all the expenses are, and throw in a lot of contingencies because you're going to have vacancies, you're going to have repairs, you're going to have all kinds of things you need to build into your cash flow forecast. And if you have a property that you're buying where you're losing a lot of money, maybe that's not the right one to buy for investment purposes. Now, here's another thing is a lot of people don't really understand why they're buying real estate in the first place. Is it for appreciation, for growth? Is it for cash flow? And I will tell you, in Southern California, where we're filming this show, in most cases, cash flow is difficult because the properties are so expensive. So most people here invest for appreciation, which means that later on in retirement, you'll probably want to sell or flip or something to utilize that net worth growth so you can live on a better cash flow. So, Joe, those are some quick thoughts in about 2 minutes or less.
Right. No, that's a really good point because we see, all right, well, here, I'm getting into retirement. I want to buy some rental properties for income. So then it depends on where you're buying these properties. If you're buying them in Southern California, well, you got an average market value here of what, $600,000-$700,000. You got some rents of $3,000. Then you have the property taxes. It's very, very difficult to get any type of income or cash flow from it. But you'll get a lot of appreciation over time. So then you want to hold leverage on it, and then that's risk. So you got to look out to Texas. You got to go to Minnesota, Tennessee, Florida, different things. And now you're owning properties way out of state. So it's not as easy as it might think. It sounds sexy, though. Hey, I want to be a landlord. Alan had a guy that parked a Harley in his condo.
Yeah, that's true, in Escondido, California.
Right.
And I had just put in new carpet, too. Imagine that. I was
He parked his Harley.
Yeah.
See, are you sure you want to own real estate, folks? All right. Hey, hopefully you enjoyed the show. Next week, we got another really good show. I want to thank Big Al. He did a phenomenal job once again today. Just carried the show. Have a wonderful weekend, everyone. We're out of here.